Most investors dream of buying at the bottom and selling at the top. But the truth is, nobody gets timing right consistently. Not even professional. Markets rise, fall, panic, recover, and most people get trapped in the emotional cycle of fear and greed. They buy too late, sell too early, and miss the big gains in between. But there's one strategy that quietly beats this chaos. One method that works whether the market is crashing, rising, or moving sideways. A strategy used by long-term millionaires, retirement funds, and disciplined investors around the world. It's simple, it's predictable, it removes emotion, and it turns volatility, the thing most investors fear, into your greatest advantage. This is the ultimate guide to dollar-cost averaging, why it works, how to use it, and how it can transform your investing journey forever. Because the smartest investors don't try to time the market. They learn how to let the market work for them. 1. What dollar-cost averaging really means. Dollar-cost averaging, DCA, is the strategy of investing a fixed amount of money at regular intervals, weekly, bi-weekly, monthly, no matter what the market is doing. You invest on good days, bad days, red days, green days. Why does it work? Because instead of buying at one price, you buy at many. When prices drop, your fixed amount buys more shares. When prices rise, that same amount buys fewer shares. Over time, this smooths out the cost of your investments and reduces the impact of short-term market swing. It's like turning volatility into a discount machine, one that automatically collects deals when others are panicking. DCA removes the pressure of making perfect timing decisions and replaces it with predictable, structured investing. It works in both bull and bear markets because it adapts automatically. And most importantly, it builds confidence. Even when the market looks uncertain, DCA isn't just a method, it's a mindset, a commitment to consistency instead of emotion. 2. How DCA protects you from market. Markets are emotional, but emotions destroy investors. Fear when prices fall, greed when prices rise, doubt when the news is noisy, FOMO when everyone else is winning. Dollar-cost averaging protects you from all of it through discipline. You invest the same amount on schedule regardless of what your feelings tell you. No hesitation, no fear, no overthinking. This automatic habit removes the biggest threat to your wealth, your emotions. DCA stops you from panic selling during downturns or chasing hype during rallies. It makes long-term investing feel calm and systematic instead of chaotic and stressful. You start trusting the process instead of reacting to headlines. And the longer you stay consistent, the more your results reflect stability rather than impulse. DCA forces you to stay invested, which is the #1 driver of long-term returns. Missing the market's best days can destroy decades of growth, and DCA ensures you never miss those days again. 3. The math behind why DCA works. DCA thrives in volatile markets, the kind that scare most beginners. Here's why. When prices fall, your fixed amount buys more units. When prices rise, your fixed amount buys fewer units. Over long periods, your average cost per share becomes lower than the average market price. This creates a powerful effect. You end up owning more shares at a lower overall cost, even without timing anything. It's not magic, it's math. Volatility becomes fuel for your portfolio instead of fear. Your buying power increases automatically during downturns without you needing to predict anything. You avoid the buy high, sell low cycle that traps emotional traders. And eventually, compounding takes over, multiplying the benefits of every share you accumulated during those lower price periods. Professional investors call this the volatility advantage, and DCA captures it perfectly. 4. Where dollar-cost averaging works. Best DCA shines in assets built for long-term growth. Index funds, S&P 500, NASDAQ global ETFs, blue-chip stocks, crypto for advanced users with high risk tolerance, retirement accounts, mutual funds. These assets move up and down constantly, creating frequent buying opportunities. But over long periods, they historically trend upward. Dollar-cost averaging helps you accumulate shares consistently during that journey, regardless of market noise. It keeps you focused on long-term growth rather than short-term dips. It simplifies decision-making because you're not switching strategies every time the news changes. And it helps you build a strong foundation, even if you're starting with a small budget. This is why retirement funds worldwide use DCA by default, because it works even when investors don't pay attention. 5. How to build your personal DCA plan. A strong dollar-cost averaging plan has 3 pillars. This can be $50 a week or $500 a month. Choose what fits your budget. What matters is consistency. Your fixed amount becomes your long-term investing habit. The goal is to build wealth slowly, not chase fast results. Even small amounts grow significantly when repeated over years. Usually a mix of index funds, large cap stocks, bonds, optional, growth-focused ETFs. Diversify enough to reduce risk without overcomplicating things. Make sure your assets match your long-term goals. If you're unsure, broad market index funds are a strong foundation. Keep it simple. Simplicity compounds. Weekly or monthly are the most common. Automate it if your broker allows. That's the real secret to long-term success. Automation removes excuses and emotional delays. It turns investing into a routine that works quietly in the background. And over time, the habit becomes more valuable than the amount you invest. A simple automatic plan can quietly grow into something extraordinary over 10, 20, or 30 years. 6. The real benefits most beginners don't see. Beyond the math, DCA delivers psychological advantages that compound just like your money. It builds discipline. Investing becomes a habit, not a reaction. It reduces regret. You never buy too high or too low. It keeps you in the market. You avoid the deadly mistake of staying on the sidelines. It simplifies decision-making. No more guessing when to buy. It grows with time. Small contributions become big numbers through compounding. But there's more. DCA helps you stay calm during market crashes because you know you're getting better prices. It prevents you from over-investing during bubbles when prices are inflated. It gives you structure, something most beginner investors desperately need. And it builds confidence as you watch your portfolio grow consistently. Dollar cost averaging doesn't just build wealth, it builds investors. 7. What DCA does not mean. Many beginners misunderstand DCA, so let's get this clear. DCA is not day trading. DCA is not timing the dips. DCA is not a get-rich-quick system. DCA is not a short-term strategy. It is long-term, steady, consistent wealth building. It requires patience, discipline, and commitment. You won't see instant result, but that's the beauty of it. DCA rewards those who stay consistent rather than those who chase trends. It works best when you treat investing like a marathon, not a sprint. And yes, DCA still works even when markets look unpredictable. That's the whole point. 8. When DCA works best and when it doesn't. DCA works exceptionally well when markets are volatile. Investors want to reduce emotional mistakes. You don't have large lump sums, you're building wealth over many years. But there's one case where DCA isn't ideal. When you have a huge lump sum that statistically performs better when invested immediately, but most beginners don't have that problem. They invest monthly, not in one large amount. Still, even with a lump sum, many people prefer DCA because it reduces regret, stress, and emotional pressure. It allows you to ease into the market instead of jumping all at once. It reduces fear when markets look uncertain, and it helps you avoid the nightmare of investing a huge amount right before a downturn. For the majority of people, DCA is the perfect strategy. Low stress, low effort, high consistency. If this guide helped you understand dollar cost averaging more deeply, imagine how powerful it will be when you actually apply it. Your money will grow steadily, your emotions will calm down, and your long-term future will start building itself, quietly, consistently, automatically. So take a moment to invest in yourself. Start small, stay consistent, and watch how time transforms your discipline into wealth. And if this video gave you clarity, hit like, subscribe, and share it with someone who still thinks investing is about luck or perfect timing. Because the truth is simple, you don't build wealth by guessing the market. You build it by staying in the market. Let consistency be your strategy. Let time be your partner. And let DCA be the habit that shapes your financial freedom.